Hello, mic test. Hello, very good morning to all and welcome to today's Daily Dose of Market Insights. I'm Kelvin here again. So very good morning. Today will be the Thursday, the 30th of May, 2024. So before we start our Daily Dose of Market Insights, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exit deposits. This presentation is not an offer or solicitation to buy or sell or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, so before we jump straight into the short-term technical outlook, I want to highlight yesterday very interesting and volatile movement across the cross-asset classes in terms of the fundamentals and intermarket relationship or analysis, we call that intermarket analysis. So before we jump that straight into this gist of it, let's have a recap of what has taken shape yesterday in terms of economic data and news flow first. All right, so let us start with the news flow. Yesterday, what important news flow over here is during the European session, we do have the, you could see my screen. Let me give a minute. I hope my screen is showing. Yeah, yes, good. All is good. Yeah. All right. So over at the European session yesterday, we do have the release of the Germany, we call it the Germany flash inflation data for May. And do not forget over here is that Germany is one of the leading country within the Eurozone, and the Eurozone will release their aggregated Eurozone inflationary data, flash data. So there's a preliminary run for May on this Friday. So they release it step by step by various key countries in the Eurozone first. So Germany was released yesterday. So the harmonized inflation rate, they call it, I don't know why they call it harmonized. In fact, it's the core inflation rate. So the core inflation rate in Germany actually went above expectation. So slightly above expectation. Market is expecting 2.8% year on year for the month of May. It's a preliminary figure. Pardon me, what I'm talking about here, sorry. The harmonized, okay, I put a bit core, it's easier to say instead of harmonized. Okay, core inflation rate for Germany preliminary for May actually came in slightly above expectation. Okay, market is expecting 2.7% year on year, but it came in at 2.8% year on year, also above 2.4% year on year in the previous month of April. And if you look at the trend of the core inflation rate, okay, I like what core, I don't put, it's the same because harmonized, I can't pronounce. Okay, core inflation rate in Germany is slowly ticking upwards. Okay, so that means, i.e., that deceleration trend of core inflation in Germany that took shape in August and July last year has started to plateau off. So what it implies over here is that very high likelihood the inflation's figure for the Eurozone one, the aggregate Eurozone one that going to be released on this coming Friday will likely show a very similar situation as well. That means previously, let me very quickly, this is what happened in the Eurozone. So Eurozone 1 will release on Friday. Okay, go all the way down. Yeah, this is the one. Okay, the core inflation. So markets were expecting 2.8%, slightly above 2.7%. And what it means over here is that it should also show very similar signs of plateauing. All right, because what you could see is that the pace of deceleration has indeed started to slow down. So what does it mean over here is that it means technically and fundamentally speaking, it should support the euro dollar. Why? Because very clearly, the first interest rate cut, like I explained earlier in my daily dose of market insights on the start of this week, or Tuesday, you could listen to it again, is being well telegraphed. Means ECB officials has really guided the market participant to almost fully price in the first interest rate cut to come in early next month, which is about 1.5 weeks from now. But the gist over here is that the subsequent interest rate cut, there may not be a second interest rate cut in 2024. That means that due to this inflationary deceleration, pressure has started to ease off. That means potentially there could be some signs of bottoming in inflationary pressure going into the Eurozone. All right, so that actually causes the ECB officials to give very murky and 50-50 outlook on their path of inflation, path of interest rate trajectory in Eurozone after that potential first interest rate cut that is being well telegraphed for the June ECB meeting, which is 1.5 weeks from now. Right. So from a fundamental perspective, it should be bullish for the euro dollar. But why the euro dollar slide yesterday is more of a momentum driven factor. For those who follow my daily dose of market insight, yesterday I do highlight is because of the very strong movement in the US Treasury yield. Okay, that causing the dollar strength to see a bit of short-term resurgence after the dollar index that highlighted showing bullish element that bounced off from the key 200-day moving average. In my chart later, I'll share you all again. Right. So this is the news. Another news over here is we're going to highlight to you all is this is more of a long-term growth forecast for China. So it seems to me that right now China seems to us from IMF perspective, not from my perspective. Okay, from IMF perspective, China deflationary risk spiral in terms of the odds of China being entrenched in deflationary risk spiral is getting slimmer because IMF right now is rather confident in terms of China growth prospect for 2024. So they actually lifted the growth forecast to 5% in line with China top policy maker 2024 GDP growth target, which is all around 5%. So initially, their forecast was 4.6%. So due to a slew of stimulus measures that was being announced by China policymaker in the last 4 weeks or so, it gave a bit of confidence for IMF to upgrade China growth forecast. So if you look at from a long-term perspective, that could also potentially be a bit of a comforting news for long-term investor in China and Hong Kong stock market, because i.e. The chances of breaking below this year low is lesser as well, given the fact that fundamental growth prospect starts to improve. But like I said earlier on, short-term movement can be driven by other factors like momentum. So yesterday I also highlighted that the Hang Seng Index, the Hong Kong 33, is facing a very weak short-term momentum where we do have a bearish bias instead for a potential corrective decline to retrace some of the strong move that was seen in the last 2 months. Right, so this is what I highlighted yesterday. Yes, we know that this, so that's the reason why we explained that why this positive news flow up from IMF upgrading China growth doesn't impact the movement of the Hong Kong 33 index or the Hang Seng index. Okay, so sometimes market doesn't move according to news flow. Okay, so that always remember that once we are looking at the short-term perspective over here, we need to pay attention also to short-term factors, primarily technical analysis factors, where we have a gauge of the short-term momentum gauges whether they are either bullish or bearish. All right, so now this is the two key news flow and events that took shape yesterday. Okay, now the next thing I want to jump on to will be the fundamental and intermarket linkage between the cross asset classes. So like I mentioned earlier on, yesterday movement, what we could see yesterday was a push up in the US 10-year Treasury yield. The US 10-year Treasury push up, we see a push up in the strength of the dollar as well. Okay, so let me share with you all, moving on to the chart. Okay, so this is the US 10-year Treasury yield. Okay, why the US 10-year Treasury yield is important? Because it's being used as a long-term benchmark for cost of funding. So i.e. if this thing keeps going up higher and higher, that means going forward, the cost of funding globally, not even in US, because US is a very key market, whatever happens in US, it could potentially spill over to the rest of the global markets. So, i.e., that's why the US 10-year Treasury yield is being used as a global benchmark to price long-term corporate loans and even more or less related to housing loans as well, or even consumer loans down the line. So what we could see is that we see 2 days of very strong movement in the US 10-year Treasury yield and breaking above the 4.5% level. That means, i.e., what we could see over here is that we could now be in the midst of a medium-term upside trajectory of the US 10-year Treasury yield, still intact from the low of 28th of December and 2nd of February this year, as it continues to trade in a series of higher high and higher low within this medium-term ascending channel that I highlighted in gray on your screen. Okay, so what's interesting is that the way it reversed off from a key support at 4.32%. That's making it much more impactful of this continuation of this bullish impulsive move within this medium-term uptrend of the US 10-year Treasury yield that's intact, and also bounce off very strongly from the key long-term 200-day moving average as well. So what we could see right now over here is that the next resistance to watch for sure will be the high point that was seen on April this year. Okay, April this year at 4.7%, and above it potentially could take us back up to 5% again. Okay, which was last year October level. Okay, and also the top of this medium-term ascending channel. So what we could see over here is there could be much more potential upside in the US 10-year Treasury yield. So with that in mind, we got to be very, very mindful that a push up in longer term cost of funding potentially doesn't gel well for the net profit margin of corporation. Why? Because on the aggregate, net profit margin could get squeezed because of cost of funding, especially for a corporation who has higher leverage. So net, it could create a negative feedback loop into the stock market, which it did yesterday. So I do mention that in the last couple of days, the stock market is being driven by momentum factor and micro factor. Micro factor is actually due to earnings result release, and the macro factor, which is the 10-year US Treasury yield, because it's a macro element, is at the point that was taking a backseat. So it seems that yesterday movement of the US 10-year Treasury yield is now taking a front seat that could actually create a much more impactful movement in the global stock market. As you could see, the movement was being expressed by yesterday across the board weakness or intraday sell-off in the major US stock indices. The S&P 500 is down 0.7%. The Nasdaq is down 0.7% as well. The Dow Jones was the worst performer, down negative 1%. Or in fact, not the Dow Jones, in fact, the Russell 2000 was the worst performer, down negative 1.5%. Given the fact that why? Because Russell 2000, majority of the component stocks in Russell 2000 are not making any decent we call it net profit margin. In fact, I'll say close to about 30% of them are not in the black, are in the red in terms of their profitability. That's why actually the increase in the US 10-year Treasury yield, which translates to the higher cost of corporate funding, put much more downside pressure on the component stock in the Russell 2000 versus a much more, we call it profitability or stronger earnings growth tech company that is being highly concentrated on the S&P 500 and the Nasdaq 100. All right, but nevertheless, because of its significant macro factor now, adverse macro factor, I would say that has now taken a front seat. Yes, we know that the Nasdaq 100, the S&P 500, the key component stocks, which is the mega cap stocks, they have very solid earnings growth prospect, but they still can't escape this negative feedback loop that is being triggered by this potential adverse macro factor that is having a front seat movement right now. And do not forget, earnings announcement for earnings announcement for Q1 is almost over. The earnings season in US is almost over, so we got to wait until somewhere around 2 months down the road again, somewhere around in July or late June, to kickstart that particular Q2 earnings Q2 earnings report season for US then. So we've got about 1.5 months or 2 months to go before micro factor takes over again. So for now, market is now seems to be more fascinated between momentum and macro factor, but unfortunately yesterday the macro factor took a front seat. Okay, so what we could see if you look at the earnings, not earnings, the S&P 500 heat map. Overall, yes, we see one sole survival, which is Nvidia, due to its AI optimism that is up 0.8%. But across the board, right, if you look at the other mega cap stocks, the technology mega cap stocks can't actually have that positive feedback loop coming up from Nvidia, where we could see that Microsoft is down negative 0.3%, Metal is down negative 1.17%, and Google is down negative 3.5%. Slightly positive movement from Apple at 0.16%. But overall, because of the adverse macro factor, the micro factor and the momentum factor cannot at this moment in time surpass the adverse movement of the macro factor. And also given the fact that the rise in the US 10-year treasury yield do also put some upside pressure on the dollar index. So if you look at the dollar index over here, we do highlight on at the start of Tuesday, do watch out for that minor dollar strength push up, which indeed happened. So yesterday it did a very strong bounce of the dollar index. So yesterday intraday bounce of positive 0.48% is the strongest single day performance of the US dollar index. Okay, the US dollar index over here since yesterday bounce was 0.48 since 30th of April. And what's interesting over here is now touching the top of this intermediate resistance at 105.20 level. Okay, and right now during the Asia session, it's forming a kind of a doji candlestick at the intraday movement at this point in time. So still recall that since early part of May, it seems to be trapping between this sideways range, okay, minor sideways range, and now it's at the top of the range again. So potentially, given that it's the top of the range, later I'll share with some of the major dollar pair has been, in terms of the dollar strength, it's been in a grossly overbought territory yesterday due to yesterday's sharp push up in the dollar. So going forward, on a short-term basis, there could be some signs of dollar strength pullback, at least in a very short-term intraday basis. So later I'll touch on the short-term technical outlook chart. And for gold, because of that dollar strength came into the picture, gold yesterday managed to actually do a bit of pullback as well, but it still hold above that 50-day moving average, didn't break below it. Oil price pretty much of a sideways movement. Initially it pushed up, and towards the end of the US session it did a bit of profit taking coming back into play, but still holding above the $78.40 barrel on the West Texas oil. All right, so that's for the intermarket analysis and the kind of the relationship between these broad-based cross asset classes in how are they going to play out. All right, so now let us now jump straight to the short-term technical outlook, starting from the FX market first. All right, so as we know that the FX market yesterday we do see a strong push up in the major dollar pair. So let us start with the European currency. All right, on the euro dollar. Okay, so with that, let me expand my screen. This euro dollar. Okay, let me expand my screen so that you guys could see. Okay, so over the euro dollar, yesterday we do have a bearish bias on the euro dollar, looking for it to come down towards this 1.08 level. Okay, 1.08 level, and it's almost hit 1.08 level, and it's now coming very close to the 200-day key moving average. All right, and what's interesting over here is that this level, this current price action over here also confluence with the former this medium-term descending channel resistance from 28th of December high now turns into a pullback support level. Okay, pullback support level as well around this zone here. So what we could see at this point in time, the RSI also has really hit the oversold region given yesterday's strong push down. So given the fact that it's now coming very close to a confluence of key intraday short-term support level at the 1.08 level, and if we do the Fibo retracement taken from the last push-up of 17 April all the way up to the 1.09 figure level, which was last 16th of May swing high, it also confluence with the 38.2% Fibo retracement as well. Yep, 30.2% Fibo retracement. So with that, I'll be using this 1.0780, slightly below 1.08 level, as my short-term pivotal support level to watch for today, for a at least flip to a bullish intraday bias for a potential minor rebound scenario. First resistance to watch will be at 1.0840. Above it exposes 1.0860. All right, when an hourly close below 1.078 will invalidate this potential minor rebound scenario to see the continuation of that euro dollar weakness, for it to extend to expose the next near-term support area at 1.0755 and 1.0730, which is also close to the 61.8 Fibo retracement, slightly lower at this 1.0715 level. All right, so that's for the euro dollar. The sterling dollar is coming very close to our support level that we highlighted yesterday. The first support level is 12670. Second support level was 126 I think 30, slightly higher, and which is close to the the lower limit of this minor ascending channel that I drew from the low of 23rd of April. So with that, and as well as the hourly RSI has really slipped to the oversold region, that could be a bit of a bounce coming into play, but I don't want to tighten it so much. So right now over here, the 20-day MA, I think as a support level is this zone here. Okay, so it's at 12670 / 12640 region. Okay, over here, let me slash it up. 2640. Okay, but I don't want to use 2640 so tight as my short-term pivotal support level. So I'll use the 12605, which is confluence with the minor swing high of 1st of May and close to the lower boundary of the minor ascending channel. So as long as this 1.2605 level is not surpassed to the downside, potentially there could be a short-term minor rebound scenario on the sterling dollar to play out, given the technical elements that I highlighted earlier on the hourly chart, hourly RSI at the oversold region, price action coming close to some key support level. So with that, potentially we'll flip to a short-term bullish bias on the intraday basis for today. First resistance to watch for sure will be this key near-term resistance zone of 1.2740 / 1.2760. Above it exposes this Tuesday swing high area at 1.28 figure level. Right, only an hourly close below 1.2605 will see the extension of this ongoing the extension of this sterling dollar weakness to expose the 200-day moving average that's acting as support at as a next support at 1.2540. Below it sees a further slide towards 1.2470, which is the minor swing low of 8th of May and 10th of May. Okay, so that's for the European currency. Now back to the Asia Pacific currency. So before the Asia Pacific, I want to highlight the firstly will be the dollar yen first. So dollar yen, if you recall yesterday, we still maintain that bullish bias inching up towards the 158 figure level. So this 158 figure level has more or less been met already, I would say, because in today's early Asia session, okay, it managed to, okay, over here before the close of yesterday US session, it hit an intraday high of 15770. Okay, more or less is there, and also with the RSI now inching down from the overbought level, and what we could see right now over here is, if I take into account of this low here, okay, the RSI seems to be now trying to break below this ascending trend line support level, okay, that I drew from the parallel low of 27th of May. Okay, at this point in time, so there is actually a big risk that upside momentum seems to be right now getting lesser to support a intraday push up on the dollar yen. So with that, I will be flipping to a bearish bias on the intraday basis on the dollar yen using 15830 slash 158 figure slash 30 as a short-term pivotal support level, and this 15830 is actually correspond to this 158 figure. Is correspond to this very strong inverted V-shape level that is printed on 1st of May, and also it actually kickstart that so-called second BOJ intervention earlier this month under the instruction of MOF to actually sell a dollar buy yen. And if you look at from a FIBO perspective, the push down from 29th of April all the way down to this low here, 3rd of May low, okay, the 15830 confluence with the 76.4 FIBO retracement. And if you look at the current FIBO extension from the rally of 16th of May, after the bounce off from this minor ascending trendline support level, which is significant, this light green line here, okay, you push it down, you project it to here, okay, it corresponds to the 0.382% on the 158 figure level. So with that, definitely for sure this is a key inflection levels, and which will be my make or break level. So as long as this 158 figure slash 30 short-term pivotal resistance is not surpassed today, potentially the dollar yen could see a bit of my cost intraday weakness. Next support level to watch will be near-term support level to watch, pardon me, be 15660. Below it exposes 15590, which is also confluence with the 20-day moving average that's acting as a support, and also the support of this minor trend line, ascending trend line that I drew from the low of 3rd of May. Only an hourly close above 15830 will invalidate this potential intraday weakness on the dollar yen to see the continuation of the squeeze up to retest the long-term pivotal resistance zone of 15960 slash 16030. Okay, so that's for the dollar yen. Now Aussie dollar. So Aussie dollar a bit of going to slide downwards, holding below the 20-day moving average. So yesterday's, but now the RSI is now back at this oversold region as well. And it's also very interestingly, if you look at the FIBO retracement of this last push up from 19th of April all the way up to the 16th of May, it's now coming close to the 38.2% FIBO retracement, okay, which confluence with this congestion area here of 9th of May and 14th of May. So with that, right, I'll be using this 65.85 as my short-term pivotal support level to watch. Okay, so as long as it didn't surpass below 65.85 short-term pivotal support level, the Aussie dollar may have a chance to actually work out from this oversold region for something like an intraday bounce. So the bounce resistance level to watch in the near term will be at 66.40. This level here, this was the level that broke down yesterday, okay, that kickstart that intraday weakness. Then above 66.40 exposes the Tuesday minor swing high of 66.80. Only an hourly close below 65.85 will totally invalidate this intraday minor bounce scenario to see the continuation of this corrective decline to expose the next support levels at 65.50, 65.20, which confluence with the 50-day and the 200-day moving average. So net overall, what we could see is that yesterday's push up in the dollar strength the movement seems to be a bit overstretched on an intraday basis. That means dollar strength scenario being hitting the respective overbought region. That means, i.e., that could be a chance or today to see a bit of this dollar strength retracement potential narrative to play out as expressed on the various major dollar pair short-term intraday technical outlook. Now, moving on will be the major indices. So let us start with the Asia Pacific indices first on the Hong Kong 33. So Hong Kong 33, yesterday we flipped to a bearish bias because it turned the price action failed to actually have a positive follow through above the 20-day moving average, and it's going to actually come down and hit the first support level at 18,240. All right, so with that, I will have a tighten key short-term pivotal support for today using last Friday minor swing low, now turns into a pullback resistance at 18,570. So as long as this 18,570 is not surpassed to the upside, potentially the Hong Kong 33 could see the continuation of this minor corrective decline to retrace the previous this month of strong move up here. So next support level to watch after 18,240 will be at 17,895, followed by 17,600, which confluence with the 50-day moving average, I think, as a support. And if you do the FIBO retracement from the low of 19th of April all the way up to the high of 17th of May, it gives us the 50% FIBO retracement and close to the 61.8% FIBO retracement, kindly very closely corresponding to the graphical level of 17,895 and 17,600. Only an hourly close above 18,570 will negate this ongoing intraday weakness on the Hong Kong 33 to potentially see a kind of a bounce back towards the 18,980 level. Above it exposes the next near-term resistance at 19,210. Right, so that's the Hong Kong 33. Then for the Japan 225, it broke yesterday. We do have a kind of a bit of a mixed bullish bias, neutral bias within that range. That means within the 20-day moving average, but first resistance to watch was the 38,975. So far it can't break above 38,975, and thereafter during the US session it actually broke down. All right, it actually staged a bearish breakdown yesterday during the European session, breaking below the 38,460, and it actually hit all the way down to the next support level at 37,750 level, this region here. And what we could see over here is that this region here is kind of important as well. Why? Because it confluences with the former descending trend line resistance from medium-term trend line resistance from 22nd of March, now turns into a pullback support level. All right, and also this 37.75 graphical support level also confluence with a FIBO retracement level as well, taken from the low of 19th of April all the way up to 20th of May high. It confluences with the golden ratio of 61.8%. And if you go to the daily chart over here of the Nikkei 225, where it actually bounces, the drop actually dropped right exactly at this major ascending channel support taken from the low of 30th of October last year, okay, by this light green line. Okay, we'll see over here, right? So given the fact that it seems to us that there is some form of support that is important for us to pay attention to, but the hourly RSI, yes, is grossly oversold, but there is no bullish divergence. It's just showing a similar lower, just at a grossly oversold level. Okay, so with that, without that bullish divergence, I'm not so confident to actually maintain that bullish bias on the Japan 225 for today. So with that, right, I'll have a neutrality stance instead for today on the Japan 225, neutral between 38,460 and 37,750/600, which is today's Asia session low. All right, so neutral between these two areas, 38,460 and 37,750/600 on the Japan 225, i.e. Nikkei 225. Now, European currency indices. So for the European indices over here is that during the, okay, so right now, right, as we are speaking right now, very similar as well. During the Asia session, right now is now inching much lower. So with that, it's now coming very close to the 50-day moving average, really, I think, as a support. So prices right now in terms of the reward risk ratio is no longer kind of attractive. But bear in mind that over here is that I'll be still using this 18,000 because right now the European session is not open yet, so still watching this 18,530 level, 18,530 level. So as long as this 18,530 level short-term pivotal resistance is not surpassed, because yesterday it break down below the 20-day moving average. Previously, this was the short-term pivotal support, so it invalidated yesterday's bullish bias. for that recovery. So it seems to us that the price action now is undergoing this minor corrective decline towards the 50-day moving average, and as well as this 50-day moving average also confluence with a very key ascending trend line support level taken from the low of 18th of January last year. Okay, a major ascending trend line supporter that I drew. Okay, touches one time, two time, three time, and didn't break. So this is a very key level to watch. So with that, yes, we could still have that very short-term intraday bearish bias for today, but the first support level to watch will be definitely for sure 18,320. If it can't break below 18,320 level and it starts to bounce, potentially that reversal could actually take form if we manage to go above that 18,530 short-term pivotal resistance, and above it, it may recapture the 20-day moving average, acting as a near-term resistance now at 18,610 level. All right, so these are the key levels to look out for the German 30 index. Now, the major US stock indices. So for the US Wall Street 30 is the weakest one. So it broke below the 50-day moving average as well, invalidating our short-term bullish bias on the US Wall Street 30 for yesterday. So it seems to us right now is doing a very much more deeper corrective pullback to in fact retrace. If you look at the daily chart over here, okay, to retrace this movement from the start of 27th October all the way up to the current all-time high area of 20th of May, because at 20th of May it can't break above the 1st April higher. Okay, right now, so we are taking things one step at a time. For sure, the near-term support level will be somewhere around this zone here. Okay, so let's go back to the hourly chart for us to have a better picture. Okay, good. Okay, so for now, we'll be using this former trend line to get this level here. Okay, this former dotted trend line support level now turns into a pullback resistance at 38,550. Okay, so definitely the RSI is oversold, so there could be a chance of a minor bounce going forward. So as long as this bounce didn't surpass 38,550, potentially the next support level to watch out for more for the continuation of this much more pronounced corrective decline in the US Wall Street 30. The next support level to watch will be at the 37,890/37,750, followed by 37,380 level, which is the minor swing low of 19th of April. And right below it, there's another, the 200-day moving average acting as a support at 36,800. But these are the two key support level to watch first, at least in the near term. 37,890/750, followed by 37,380, as long as 38,550 is not being surpassed on the upside. But however, if the bounce starts to go above 38,550, then this short-term bearish bias will be invalidated to start to see a much a recovery to take shape in the US Wall Street 30. Next resistance to watch for that recovery to unfold in the short term. The next resistance will be at 38,975, 38,970, 39,130, which is the 50-day moving average and close to the 20-day moving average, and above it exposes 39,390. Okay, so that's for the Wall Street 30. The Nasdaq 100, because it do have the support of some of the mega cap stocks that has a higher weightage in the Nasdaq 100. So far it's still trading above the 20 and the 50-day moving average. So what we could see is that yesterday we do have a tightened key short-term pivotal support level yesterday. So yesterday I have at around 18,790 level. So this level has really been surpassed to the downside. So very likely now and also the breakdown of this minor ascending channel that I drew from the low of 1st of May. Okay, so now this ascending channel support level now turns to be a key pullback resistance level, which is close to yesterday's US session high as well at 18,850. So as long as it didn't surpass any bounce, because now it's at the oversold region on the hourly RSI, so potentially there could be a minor bounce coming into play. So first resistance to watch for that minor bounce will be this level here at 18,720 level. So but as long as the bounce didn't surpass 18,850 level, potentially the Nasdaq 100 could be unfolding a minor corrective decline scenario to expose the next near-term support area at 18,580. Below it, it exposes 18,470 level, which is also confluence with the upward sloping 20-day moving average. All right. However, an hourly close back above 18,850 will see the continuation of that bullish impulsive upmove sequence to kind of give way for the next near-term resistance to come in at 18,990/19,055, followed by 19,160/19,180, which is defined by a Fibonacci extension cluster zone. All right, so net overall, right, we due to yesterday's push down in the break of their respective key pivotal support level, we will now have a we call it low odds of this bullish impulsive move to continue on the Nasdaq 100, the Wall Street, the German 30, and the Japan 225. Seems to us that adverse macro factor is now taking a front seat that drives the movement, at least the short-term movement of these indices. So we will flip to a bearish bias, and on the US Wall Street 30, the Nasdaq 100, and the Germany 30. Mixed bag for now on the Japan 225, and we still maintain that ongoing corrective decline scenario. We in a medium-term uptrend phase on the Hong Kong 33 index for now. Okay, so that's for the indices. Very quickly now, let us take a look at the commodities, starting with the spot gold. So spot gold continues to actually hold on to our 2,327 Titan short-term pivotal support level that we have yesterday, and also close to the 50-day moving average as well. Okay, despite the fact that it starts to sell off in line with the push up in the US dollar. So given the intercorrelation between the indirect correlation with the US dollar in yesterday's session. So I do highlight that the US dollar strength is being overbought in the short-term intraday basis. So there could be a chance due to its inverse relationship with the US dollar, gold could actually potentially see an intraday bounce at this juncture since it's being held on to the 2,327 short-term pivotal support level hasn't break. And what's interesting over here is that after a retest at the 2,327 short-term pivotal support, right now as we are speaking during the Asia session, the hourly RSI has started to flash a bullish divergence after hitting the oversold level region during yesterday's start of the US session, and right now you start to shape a higher low. So indicating to us there's some form of easing off in this intraday downside momentum. So with that, potentially, we still maintain that short-term bullish bias on spot gold XAU/USD, but with a lower level short-term resistance level to watch in the first step. So first resistance to watch will be yesterday's minor swing high area at 2,360. Only above it exposes 2,382. However, an hourly close below 2,327 will invalidate this bullish bias to see the continuation of this corrective decline within its major uptrend phase. To expose the next near-term support at 2,307, followed by 2,280/2,260 level. Then this is WTI crude. So WTI crude, yesterday we do have a bullish bias. Why? Because price action managed to surpass above the 200-day moving average. So during the European session and the US session, continued to push up. Then thereafter, towards the start of the US session, pardon me, during the European session it pushed up, but during the start of the US session it continues to actually decline. But where it declined, it managed to pause right at the first support level that we highlight at 78.90 and still trading above the 20-day moving average that's acting as a support at 78.90. So first we support 79.50 and 78.90 was the 20-day moving average support, and also our short-term pivotal support that we highlighted yesterday. So no change. These are the two key levels to watch to maintain that short-term bullish biasness on the West Texas oil. So as long as 78.90 short-term pivotal support is not surpassed to the downside, we still maintain that short-term bullish bias on the West Texas crude oil. So for the first resistance to watch out for today will be yesterday's minor swing high at 81 figure level. So only above 81 figure level will expose the next near-term resistance at 81.70, this graphical resistance zone here, and as well as the 50-day moving average also acting very closely as a resistance at 81.70. Only hourly close below 78.90 will see another round of whipsaw movement to reintegrate back towards the next support at 78.20, followed by 76.70, which is the key minor swing low of 15th of May and 24th of May. Okay, so that's pretty much sum up for today's short-term technical outlook across the major cross-asset classes. So before we go, right, let's have a quick look at the calendar. I want to highlight what are the key economic data for you guys to take note of throughout the entire session for today. Okay, so today, give me a minute, let me go to the Thursday one. Yeah, this is Thursday. So what we could see over here is during the the early part of the later part of the Asia session will be pretty quiet. Only at 5 p.m. Singapore time, we do have another economic sentiment data out from Eurozone for the month of May at 5 p.m. Singapore time. And we do have the unemployment rate as well for Eurozone released at 5 p.m. Singapore time. All right, and we do have this consumer inflation expectation at 5 p.m. Singapore time releasing as well for the Eurozone, all right, at 5 p.m. Singapore time. And during the US session, we have I think this shouldn't be quite important. Why? Because this is the second estimate of their Q1 GDP growth at 8:30 p.m. Singapore time. And thereafter, pretty much quiet session, we do have some pending home sales data for the month of April, but this is quite lagging because it's April, 10 p.m. Singapore time. And much more related to the WTI crude oil market will be the weekly release of the EIA compound crude oil stockpile change for the week ending of 24th of May. So markets are now expecting after a surprise increase of 1.825 million barrel, now market is expecting a drawdown of negative 1.9 million barrel, okay, in US in terms of their crude oil weekly stockpile change as compiled by EIA agency. So with that, that's all for now. We do have two Fed speeches at 12:05 a.m. Singapore time. Fed William is speaking, and early Asia session morning tomorrow at 5 a.m. Singapore time, Fed Logan is speaking. All right. So with that pretty much sum up for today's Daily Dose of Market Insights. Kelvin here signing off, and I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.